stocks, etc. So what do we have? I think we have a bit of a downtick. Nifty starting, I think, about 0.2% lower. So 24,300 is where the Nifty is at. And I think you've got the Bank Nifty, which is starting about 1/3% lower. So 0.3%, that's about 80 points worth of a cut on the Nifty. Bank Nifty 200-point cut, 50,271. And individual sector stocks, etc. Market breadth is negative, almost about 2:1. Not quite fully 2:1, but right out of the gates, more down than up. That's essentially the picture. Small cap index is down 0.6, and I think you've got the mid cap index, which is also under some pressure. Nifty is down about 90 points, 24,286 at this stage. So this is the market open, but it's all about stocks. So let's get straight to it.
Yes, well, that's right. Pull up Voltas. The last few days the stock was a little bit nervous. Those numbers look good. The margins have come in at the highest levels you've seen all the way since March 2022, since that quarter. That stock has burst up close to around 5%. When tepid into the numbers, I think that's one of the reasons. Amara Raja, well, we have positive news flow that the stock is up close to around 2.5%. Jubilant Food, Mangalam told us those numbers are good, so that stock is flying away. Balkrishna Industries, Sudarshan had highlighted this fact that the numbers were more or less in line or mildly better. The problem is going ahead, things are looking very jittery. So that's why that stock's lost close to around 9%. Sun TV as well down close to around 5.5%, has had a good run. But now, in fact, that's come in for some big profit taking. So, that one comes up for you on the screen. And Ola Electric, well, continues its electrifying ways. Stock is up close to 7.5%, following in that big gain that we saw in Friday's trading session, the listing gains. And also Coffee Day, that the insolvency has taken shape out there. And because of that, the stock is down. It's getting smacked as we speak. You have Imfa, that's the other one that got the 221 crores that were pending. So maybe that one as well is reacting to that piece of news. So all these stocks up and about in today's trading session.
A bunch of other stocks also in focus. If you look at the market breadth, you'd have nearly two stocks declining for every one stock which is advancing. But the ones which are advancing, we have a few of them as well. Inox Wind reported a good set of numbers, stock up around 6%. Good numbers coming in from Shipping Corp as well. That stock's up around 5.5%. Some softness in metro brands. The stock opened red, but thereafter the street is looking at triggers ahead, and as a result of which it's moved off lows, currently in mild green. Though we are seeing incremental pressure on names like Sun TV, which is now down about 7%. Astral's the other one, and Bharat Forge, after a decent move that we saw on Friday, has seen a bit of profit booking. Trent, an 11% up move is what we saw on Friday, and this morning it follows up with another 2%, and it's only increasing with volumes piling up out there. And Jubilant Foodworks too, which opened about 1.5% in the green, has now extended its gains to about 3% the street, eyeing a turnaround out there.
Well, so a few other names, right? Ola Electric will come up on your screen. Ola Electric is the biggest volume-led gainer on the NSE. It's up 8%, and we were talking about this one in the morning with Prakash. So that is coming up with sort of large volume-led gains right now. So that is Ola for you. Nigel mentioned Voltas. That's a big one, 6% pop. Inox Wind is up about 5.75%, humongous volumes. Shipping Corporation, I think numbers, 4.5 higher, 270. Mangalam was talking about Jubilant Food. I think there is an upgrade from Jefferies as well, 617 on Jubilant Food. Aavas Financiers, actually there are two microfinance companies. Aavas Financiers is up 7%. There is a deal brewing there. And the other one, of course, is Credit Access, where there are reports this morning which suggest that, the foreign owner is actually looking to get out. So that's the stock's down about 1%. Credit Access, of course, in terms of the MFI space, is rated as, is seen as the highest quality lender in that in the microfinance area. Safari is up 4.5%. That's a luggage maker, 2410. Big volumes at this point. For this time of the day, actually. Coromandel is up about 2%. Graphite is up about 3%. Graphite India, 536. PNC Infra is coming up with a 7% gain, 480. There's more stuff. Ola Electric is up 12% now. So keep an eye on. Actually, we should put up the Ola Electric stock. There's a lot of interest, huge volumes as well, right at the bottom of the screen. It's the largest volume-led gainer. And of course, I think as Nigel mentioned, a lot of the Adani Group stocks are under pressure. Enterprises, Ports, Power, Green, they're all down between 3 and 5-6%. Adani Wilmar, Adani Total Gas down 4-5% as well. So this is broadly how we are starting up.
Just one word on Voltas, Prashant. The reason that the stock is reacting so much on the upside is the last few days, the stock actually had corrected close to around 6%. It actually it underperformed the market going into these numbers. And by the look of it, the sense is that they could have gained some market share in the last quarter on a quarter-to-quarter basis as well, roughly 200-250 basis points. I'm reading a sales note out there. Yeah. So commentary on pricing will be important. Sustenance of these kind of margins as well as inventory situation. That seems to be the stock of the morning after those numbers.
Absolutely. And very large, 2 million shares also on the NSE. So this is looking pretty solid out there. Well, let's bring in Rajiv Batra. He's, of course, with Joe. Okay, I think Rajiv will be with us in just a bit. Maybe just a couple of more names before we take it forward. Bharat Dynamics, BDL, is down 8%. That's the defense company, a PSU defense company, 1318 on Bharat Dynamics. And of course, it's come off quite sharply from the highs. I mean, the high in the month of July, actually, this is the all-time high, as well as about 1720. From 1720 to 1318. About 15 trading sessions, not even 15 trading sessions. So that is a very sharp knock that we are seeing here. Lemon Tree has not been able to recover. It's basically a waterfall decline from 150 levels to 116. The first quarter numbers, of course, were a bit of a miss. But, the decline started much before that. The all-time high on Lemon Tree was about 160 rupees. So that's lost quite a bit. And there is IIFL this morning, which is also down about 2 3/4%. Stocks at about 411, 412 or so. So this is some of what is going on across on the market front. Rajiv Batra is with us. He's of course, with JP Morgan. Rajiv, great to have you with us here. Thank you very much for your time. Appreciate it. Prashant this side. I'm looking at what your note says, and I'm sort of just read out this portion of for our viewers, because this is the operative part. What you're saying is, we worry that such rapid market declines, and you're referring, of course, to what we saw in the Japanese market and, all of the volatility last week. You say, and I quote, we worry that such rapid market declines often lead to unexpected ruptures in the market, from spillovers and cross-asset volatility, dispersion, and private markets to at least margin calls. And any bounds here may not sustain far until we arrive at a new market structure equilibrium. Is that the operative part, Rajiv? Is that kind of sort of in one line the view that you're sort of telling your clients when you're speaking with them?
Exactly. That's what we have been expecting for the second half. So when we wrote the outlook note start of the year, we said to our investor that first half, you will be able to make a good set of a return. Market may operates in a Goldilocks period. And hence, we have seen Asia ex-Japan index operated in the base case and the bull case territory for us. But we knew as we head into the second half, if the positionings are overcrowded and going into one of the biggest event of the year, US election, there could be some round of uncertainty, even in terms of if monetary policy regime is also shifting from tightening to easing. That's what we exactly saw over the last 1 month, where middle of July, due to the tech earnings season weakness in the US, we saw the first bout of the volatility. And now, last week, the second bout of volatility hit due to the carry trade unwinding and the rising US recession risk. And we believe this bout of volatility may need to continue because of either the geopolitical uncertainty, the activity data which is weakening in the US, and maybe even because of some exaggerated or overcrowded positioning in the equity markets too.
So how do you suggest one play this extended period of volatility up until at least the events get out of the way, Rajiv? What are your sector calls, and what are you suggesting investors do to protect themselves from such sort of volatility?
So the prudent measures would be, rather than taking the clear country or a sector call, people should take call within the sectors and more on the factors or the style basis. So the styles or factors which have not done well so far this year, as an example, low walls, quality, or even defensiveness, that's what should be the key part of your portfolio, because in the next month or two, when the volatility swings will keep on happening, the low wall or quality exposures, or even a marginal sustainable growth exposure will help you safeguard your portfolio and prep you up for a possible year-end rally also. But till then, capital protection is utmost important.
All right. Hi, Rajiv. Good morning and good to see you. When the big story here for most Indian investors is we are cheering the decoupling. The globe will fall, but if it falls, we'll fall less. And if it goes up, we'll go up more. That's what we believe, at least. Oh, but at current valuations, what's your view on the Indian markets? You know, a lot of challenges have come about. We didn't get an absolute majority of the ruling government. We got a tweaking in capital gains, but still the market's just 2% away from fresh all-time highs. Your comment on this?
No, so definitely, if you look at the trade over the last month or so, when the global volatility is happening, domestics are faring far bit better. So be it India, be it Southeast Asia, ASEAN market, or even if China, the more you have a domestic exposure, the better off you are. And this is the reason why when markets are declining, these domestic exposures are outperforming. Even based on the feedback from investors whom I'm been talking and traveling and meeting last 5 weeks, have been very clear that they need to increase their exposure substantially towards the domestic haven, that is more South Asia part of the world compared to the North Asia, because of the gyration they are expected to see in the economic data prints in the North Asia side. Coming back to the India, yes, definitely valuations are expensive. And after a bout of inflows, which we have seen post-election result, there is a merit that market could take a breather before again start inching up higher. So tailwinds, positive tailwinds which were there in place like earnings, budget, or even continuity of policy, that tailwinds are now coming to an end and headwinds are approaching. So seasonally, if we see September 8 out of the 10 years is a weaker month for India. Besides that, earnings, if you will look this quarter, have been lackluster or sideline in line with what everyone expected. And then most obviously, state elections are approaching, which can make people think or have a deja vu of the last year, where going into the state election, markets were on the sideline. So for India, relative terms, we could be still an outperformer, keep on doing well. But absolute term, we will be in a range-bound state.
Speaking about range-bound, you know, there is no dip in Siemens, which is not bought. In fact, this stock opened mildly in the red. Vamakshi did tell us that there was weakness in their mobility business margins, and that dip has been swiftly bought into. The stocks recovered about 3.5–4% from the lows, stock back above that 7,000 mark, and has moved higher. It's already seen a big move, almost 75% from the start of this year. Not particularly comfortable when it comes to valuations as well, but maybe the street is eyeing some more in Siemens going on from here on, and that explains why the dip on that stock has been bought into.
No, absolutely, and you know, there's a fair bit of interest in some of these names that we have been talking about, and that continues. Sun TV is down. Sun TV is down 8%.
Yeah.
So stocks at about what, 842? That's a large cut that we're talking about. You know, it closed at about 916, 917, at about 842. At this point in time. So it's basically been pushing lower from the word go, although it's just still about 10 minutes or so as far as market open is concerned.
The problems are on the margins. The margins, 500 basis points contraction on a year-on-year as well as on a sequential basis. Top line was okay, but I guess that's one of the reasons. It's not as cheap as it was. I think 2.5 months ago, it was at around 650 rupees odd. So at that point of time, the core business, I think you were getting it at around 4 times EV on EBITDA. X of the cash, X of the IPL franchise, if you put a value to that. So now it's not as cheap. So I think the room for, you know, in terms of that valuation comfort went out. I guess that's why the stock is getting pulled back.
Room for disappointment is zero.
Very, very minimal.
So, I mean,
but some of these Adani Group stocks actually have come off the low point of the day. You know, Adani, some of these Adani Total Gas as well, it's come off a little bit from the low point of the day. I think Adani Enterprises as well. So, yeah, that's the frontline name. Let's pull up Adani Ports as well. So, some bit of recovery from the day's low. Adani Energy Solutions, we had highlighted that there was a big difference, you know, between both the rates. So recovery on one of those groups that are in focus today.
I think, yeah, that's absolutely right. Astral is another one I want to highlight. Again, you know, one of these names, again, first quarter numbers were nothing great. We spoke with the management on Friday morning. From 2,500 stocks down to 1,950 or so very quickly. Last 10 or 15 trading sessions is more like it. So there is, I mean, price damage occurring on a wide sort of wide swath of stocks. Midhani, which is Mishra Dhatu, I think there was massive compression in margins here. So high was 540, 550. Stocks at about 420 now. Although today, from the day's lowest point, is actually trying to come back up a little bit. Zydus Life is another one, has had a one-way move higher. But it's kind of sort of, I think, faltering a little bit in today's trading session. For the year, it's up 80%, Zydus Life.
I think even Stovecraft, we had the management.
Yeah.
When you had TTK Prestige, it didn't grow, and Butterfly Gandhimati actually gave a degrowth.
Yeah.
They grew a little bit, and they're promising better times ahead. They've disappointed in the past, but for the time being, Stovecraft is up close to around 6%. So the street will eye delivery, because actually the stock is still, I think, not made the high that it made when it post-listing. So it's still a distance away from there.
Absolutely. It's been one of those sort of underperformers in a market where there's not very many underperformers, the outperformers. Rajiv, from a flow perspective, right? What does all of this, the spike in global volatility, etc., mean for India? I mean, the market here in India has been driven almost entirely by local investors, right? And that is the bid under this market. Over the last 3-4 shocks, some mini, some slightly more than mini, the election, the tax change, the recent yen episode, market from high to low, the Nifty fell just 4.5% in local currency terms, the least amongst major markets. The question, though, is, does this delay, when foreign investors come back into this market, what's happening globally? What's your sense?
Definitely, local investors are not going to be an issue. We continue to expect domestic keeps on buying into the equity market, looking at their balance sheet exposure, which are still quite low on the equity exposure side. So domestic inflows we expected to continue through SIP, lump sum, and NFO kind of a route. Talking about the global investors, it was very interesting during the budget time while I was in the US. Investors were disappointed to see that during the budget day, there was not a deep correction, because everyone was looking for correction to buy, was planning to buy into this correction or a dip of a budget if that would have happened. So what foreign investors are looking like, if any dip comes in India at a single stock level or at a sector level where the value is emerging, they will be buyer into that. And if you would have seen since election and take last one and a half week out, there was a period we got close to $9 to $10 billion of inflow in Indian equities. That is an evidence that foreign investors are more than happy to cut down their underweights on India, go towards a neutral kind of a territory, but want to pick up sectors or stocks where value has started emerging. So that provides another set of a confidence to the investors that even in case if India is declining, a lot of money is still waiting on the sideline to enter into Indian equity markets.
All right, take that point. A lot of money is waiting on the sidelines to enter the Indian equity markets, and that seems to be the order of today's trading session so far as well. 15 minutes into opening, now we have the early rates which have settled in. The Nifty has actually recovered a fair bit from the lows, and the mid-cap index, that's really been the star of the morning so far. At one point was down by almost 0.75%, now down by just about 100 points, a tenth of each. And the story would also be clearer if you look at just the advanced decline lines of the last 15 minutes or so. When we started out, we had nearly, 3 stocks declining for every stock which was advancing. That moved on to closer to 2. And now those lines have come perilously close to each other. Just about 1,000 stocks advancing for about 1,300 stocks which are declining. So if the mid-cap index does recover, that tells you that maybe we're out of worries. A lot of these individual stocks surging. You have Trent, which has now made the highs of the morning. Apart from that, we're seeing increased traction on Coromandel. It was, I think, Sudarshan's 9 a.m. pick. So just pull up Coromandel International as well. And then you have names like Granules, Metropolis. The paint space, that's done well too. We had Berger Paints report numbers on Friday telling you that they saw the maximum amount of market share gain in a quarter this time around in the first quarter. That stock's done extremely well. Asian Paints too is out of the woods now, currently in the green. A lot of these cash market stocks seeing bigger moves as well. Real estate sector, we have Macrotech Developers up around 5%, Parag Milk up around 5%, Allied Blenders up around 5% as well. So we'll keep an eye out of the broader markets. Now seems like we've seen some bit of recovery from the lows, the broader markets recovering faster. Let's focus on ABB, which reported a strong set of numbers in the first quarter, CY24 as well. EBITDA margins coming in at a record high, expanded by nearly 526 basis points. And there have been a big surge in the profitability as well. Our colleague Vamakshi caught up with the management and began by asking on if they continue to hold on to the margin guidance that they'd given at the start of this year. Listen in.
Rightly captured that 300 basis points come from the internal efficiencies what we have derived so far. But of course, you should understand that this internal efficiencies also is driven by the volume growth which we are seeing in the market, right? And so that's something which is very important for us to sustain. So, and if that particular margin, if you want to sustain, it's important that we have the volume growth also supporting it. So that's number one. And number two is, I think productivity is definitely a topic which is very important for every business. And they look at all options where they could be productive and improve their efficiencies in this particular journey, right? So I think it's a route of discovery every day. And so as and when people try to find out how they could unlock this particular value, right, to the shareholders and to the bottom line of the numbers, I think it should pretty much work out. But the question is there an end to this, or is there something which will deter this? I think it all depends on how the situation develops. And as the volume supports, I think the journey of discovery still continues.
Well, absolutely. And just a follow-up question on the margins. Now, of course, you have been importing tech and that is under the normal course of business. But what is the kind of royalty fees that you're paying as a percentage of your sales? Has it increased? Because we're seeing a rise in the other expenses. And, I'm just trying to understand here, what portion of this improvement in margins is being driven by localization as well as the pricing power?
I think pricing power is definitely on the external side of it. It's basically how the customers are willing to pay for the quality of the products which are the services what we're providing. And we have seen this actually going through a transformation journey in the market. So that's why we could see that also reflecting in the margins. That means people are able to pay and are willing to pay for the quality and the technology what ABB is able to provide. That's number one, right? And the number two is regarding how can we make sure that this actually is held together is again depending on the demand situation which is developing in the market. And we are sort of seeing a very positive view of it at this point of time, right? So with the elections and the budgets all done, so we have a stable government in the at the center. So I think it's only the capex cycle which has to follow, which we are all expecting. So it's sort of unfold in the coming times. And coming to the royalty part of it, we pay 2.89 to 3% as royalty, 1% as for the brand royalty, which is called as trademark fees. So this is basically what we pay on account of royalty and trademark.
All right, sure. Thank you so much for that. And now coming to Mr. Sharma, ordering activity in the first quarter was rather muted, and of course it could be expected mainly on account of the elections as well as the budget that just got concluded. So would just like to ask you about the outlook going ahead. How is the pipeline shaping up now in the 4 segments that you operate in, and what is the conversion rate that you're expecting?
Well, thanks for having us. Well, as far as our 4 verticals are concerned, these 4 verticals have 18 business divisions. And our sense of having come out of election and the budget period is that the pipeline ahead is quite robust for us. And we operate with 18 divisions and 23 market segments. So overall pipeline for us, where our interest lies, it looks good at the moment.
All right, and order inflow in the first quarter was supported by large orders. So is this trend expected to continue going forward in the year as well? And do you expect the mix of nearly 40 to 45% of large orders in the overall order book to continue, or is there a change expected here?
Well, we do expect it because as far as the flow business is concerned, which we call as the fast-moving industrial goods, which are mainly in our electrification and motion business, which constitutes about 75% of our business. We do expect continuous strong flows there going forward. In the market segments, we see good activity. As far as the large projects are concerned, they come from the core sectors or major spenders like railways, metros, and they are not the ones which repeat every month, but then they keep coming every quarter or two.
All right, got that. And let's also talk about exports because they've seen a good growth of almost 39% this time around. And this is despite the geopolitical risk as well as the trade disruptions that we're seeing. So is this good growth in exports expected to continue? And it currently accounts nearly 10% of your overall share. So is this expected to rise further?
So our primary focus as a multinational corporation dedicated for India is Indian market, domestic market, and that's where we see maximum growth coming for us going forward, and we see the activity quite in favor of our portfolio. Now, our operations in the country, as I said, we have 25 factories and a fair bit of localization. they're increasingly becoming attractive factories for our global businesses, and they're increasingly giving the allocations of different markets to be served out of India. So we see this is a long-term story for us, and we continue to gain out of it. So different businesses have the mandate to export to different markets as allocated by our global businesses, and we see this trend will continue.
Sure. And, one last question to Mr. Sridhar, actually. So I know you don't give forward-looking guidance, but, revenue growth was definitely muted in first quarter as compared to, in the second quarter as compared to the first quarter and the previous year. But what would the top-line growth look like this year in comparison to the growth that we saw last year? Is it going to be at similar levels, or is the growth rate expected to be better than last year?
So I think when we look at 23, all right, you are comparing with 22, and 22, of course, comes strongly from the COVID period of 21 as well. I think the growth rate was very much faster and higher when you see 23 to 22. But when you look from 24 to 23, you're looking at a base which is very constant, which is 23 was pretty much very solid in that way. So in the 24, of course, we'll have growth. And I think we have been growing at a good double-digit number at this point of time, and we will definitely maintain that. I think if I want to allude on the topic of backlog, so our backlog, which is roughly around about 9,300 crores, is consisting of both large orders, which have an execution time cycle of a minimum of 15 to 18 months, and then you also have almost 55% coming from the short cycle orders, which have an execution time of 6 to 9 months. I think this has a pattern to convert itself, and we are sure that this will get sort of executed in the periods to come. And our aim is to make sure that we are there with a double-digit growth quarter on quarter. That's what we have been looking for. So this quarter, coming to this quarter, yes, we missed roughly around 150 to 200 crores of revenue. That's more because the economy was waiting for some important decisions followed by the budget as well. So that made the businesses to wait for an outcome of it, and therefore it was a more conscious call from the businesses to make sure that they are aligned with macro topics to be there. So I think we see this as a momentary shift, and we are making sure that every effort is done to catch up with this particular slippage which happened in the second quarter.
All right. Thank you so much, gentlemen, for that conversation that really cleared the air about the margins as well as the order outlook. Thank you so much.
Thank you. Thank you.
All right, that was the management of ABB. The stock down about 1.5%. Let's talk about another one, which is seeing a big up move. That's Inox Wind. It was a strong quarter for the company. Sharp expansion in the EBITDA margin due to superior sales mix. Devansh Jain, who's the ED of Inox, joins in now to give us more on the first quarter performance, but more importantly, what the year ahead looks like. Thanks a lot for joining in. First up, if you could, confirm whether this 140 megawatts of execution run rate continues through this year. What's the outlook out here? And margins as well. I mean, very strong, a little about 21%. Does that sustain? What are the levers here?
Hi, good morning. Pleasure to be back on CNBC. So as you know, Q1 was the highest financial performance in the history of Inox Wind. Our revenue was up about 85% and EBITDA was up almost 350%. Coming to your question on margins, look, we've guided for about 15 to 16% margin for the entire financial year. And obviously, there could be a slight upside to that as we move forward. But having said that, we continue to maintain our guidance at 15 to 16%. This quarter has been close to 21%, but I think in the course of the full financial year, we should be closer to the numbers I spoke about. With respect to the 140 megawatts you talk about, as I think is well known in the industry, Q1 is probably the lowest, Q1 and Q2, given that it's onset of monsoon, and Q3 and Q4 typically are the highest. So I would tend to think that Q3 and Q4 would be far larger than our Q1 numbers.
All right. Hi, Devansh. First of all, congratulations on a good set of numbers. You have been walking the talk, so that's good news from an investor's perspective. A couple of details I wanted. Are you facing some logistical issues? Because that's what some part of the street believes. Could you clarify on that front? And what is the breakup? This 800 megawatt is well and truly on, 300 in the first half and 500 in the second half. Give us some more details on that, on the execution.
Look, I'm not sure where this logistical issue question has come up from. We face no constraints whatsoever.
Okay.
Business is on track. We have publicly stated our vision to be a 2 gigawatt company in the near future. And I think we should be achieving that sooner than what is expected by most of the street. We've also gone on record to say that there is a fairly large upside to our FY26 numbers. While we've not upgraded the 800 and 1200 megawatts targets which we've set out for ourselves for 25 and 26, I think the order book in itself speaks volumes, and our current run rate of execution and profitability gives a fair amount of hint of where we are headed. With respect to your question of 300 and 500, look, we've stated our guidance of being an 800 megawatt supply or execution company this financial year. And I think we are very well on track to achieve that.
Got it, Devansh. So 15-16% margins, 800 and 1200 megawatt in the next couple of years, and no logistical issues. Part of the investor community had that query, so that's why I put it across to you. Let's get a couple of more details. Your current order book is around 2.9 gigawatt. Over what span do you see this getting executed? And also, if you could give us a sense of the commercial and industrial demand. Is that strong? If yes, should we be looking forward to some more announcements on closure of some orders?
Look, the 2.9 gigawatt order book, again, is the largest we've ever had in our history. Typically, this is something which we would execute in about 2 years. You typically get orders, private sector gives you orders which typically give you an execution timeline of about 12 months. PSUs typically give you orders where the peak execution cycle is about 24 months. And then you've got retail and smaller C&I, which would be about 6 to 9 months, within which I would tend to believe the 2.9 would be executed in the next 24 months. Again, I did mention that we are gunning to be a 2 gigawatt company in the near future. But again, depending on how fast and how large the Indian market is, we could see a much larger play out as we move forward. As we've announced in this quarter, we've already started setting up a larger nacelle manufacturing facility in Ahmedabad in Gujarat, which would enhance our ability to manufacture beyond 2.5 gigawatts of nacelles. So we are gearing up for the future. With respect to the CNI order book, I think we're seeing tremendous momentum, driven by multiple reasons. Primarily, of course, is that renewables is the cheapest source of power. Second, I think a lot of exporters, given that you now have CBAM coming up in Europe and eventually carbon taxes coming up in different parts of the world, particularly the developed countries, you would need green credentials and renewable power. And what's better than renewable energy? Moreover, a lot of the larger corporates are setting up their own platforms. So it's a win-win. They raise equity there. They create value on that front. The operating entities themselves, without any capex, gain significantly. We will be announcing a much larger play even within the Inox GFL group for our own captive renewable energy requirements. But I think the CNI market is booming.
Right.
We've announced about 600...
Devansh, just a quick word. In terms of acquisitions, I mean, Suzlon recently announced an acquisition on the OMS side. Will a lot of this ambition be via sort of buying companies? I mean, are there enough players in the market? I mean, that Suzlon, we spoke with the management of Suzlon. It was it was on the OMS side, and it was pretty small as compared to Suzlon's size. I mean, so just give us a sense of that. How much of this ambition is going to be via acquiring companies out there?
Look, what we're talking about is our Inox Wind, which is a manufacturing company supplying turbines. And on the CNI side, you're really supplying newer and newer turbines to take care of the incremental power requirements or the existing power requirements of thermal, which are being replaced by renewable energy. O&M is a different piece altogether. That's something, as you may be well aware, we probably have the only...
Devan, I was just using that as an example. Are there, on the manufacturing side, will there be sort of M&A strategy? Are you looking at opportunities?
Well, we are looking at opportunities, but that's more on the O&M side, not on the manufacturing side.
Okay.
I think at Inox Wind, we have the lowest cost structure. So I don't think there's anybody to acquire out there in terms of who could be value accretive to Inox Wind. But
so
yes,
just two-part question. Right.
A lot of acquisitions on the Inox Green side of things, where we expand our O&M portfolio.
All right, so just two-part question then. One would be on the acquisition itself. What is the size that you're targeting, if any timelines, etc.? That's point number one. And secondly, you did briefly speak about CNI. If you could give us a sense of how big the market is, how big do you expect to be in this over the next couple of years?
I'm sorry, I could not hear you. I think there's a cross connection. Could you repeat?
Yeah, so can you hear me now?
Hello?
All right, you want to try this?
Yes, Devansh, are we audible?
Yes, yes.
All right. I think Mangalam has a query, but he'll get back with that one. I wanted to ask you about the interest cost. You know, on a quarterly basis, for the last few quarters, it's been in that vicinity of around 56 to around 65 crores per quarter. Now, for the past quarter, your PAT number itself was close to 50 crores. But as you'll have put in some money and you're virtually debt-free, if I understand correctly, that interest cost should come down on a quarterly basis. So from this 55, 65 crores per quarter, what does the interest cost come down to from quarter two onwards?
Look, I think we did mention we are now a net cash entity.
Yes.
And what's also been publicly stated is from Q2, our net finance costs should be negligible. So yes, you see a large chunk, you see 50, 58 crores over the past 2 quarters, but a lot of it also had to do with a lot of the repayments we were doing and a lot of one-time charges. I think for the full financial year, we've guided for net finance costs to be in the vicinity of 60 to 75 crores, which would entail a saving of almost 200 crores from the previous financial year. And given the fact that we are net cash now, I think this is behind us. I don't think finance cost is something which is going to be anything which is going to be really key. It's really going to add to the bottom line going forward.
Yeah, that's the reason I ask you that, because as of now, PAT as well as interest costs are almost the same. So that interest cost comes down drastically,
I think
then that will get added to the profitability.
I think that should virtually double, given that we've mentioned that interest costs from the next quarter should be negligible.
All right, final question then. I hope you can hear me now. Is because on the CNI business itself, you said that on O&M, you're looking at some opportunities. So if you could give us a sense of the size and the timeline that you're looking at in terms of any sort of inorganic plans there. And secondly, on CNI, how big are you planning to be here in the next, say, 1 to 2 years?
Look, first and foremost, on the O&M opportunity in Inox Wind, we had recently raised about 1,050 crores, which is primary. We are evaluating multiple opportunities as we speak, but we have a very prudent capital allocation policy. We will not buy out entities just them out or at numbers which make no commercial sense to us. We are looking at a very accretive business model under Inox Green, which is beyond just servicing turbines. We'll talk about that more as we in the coming months. But I think we are evaluating multiple opportunities. That's all that I can say at this point in time. With respect to the CNI market, look, I think, we are not married to CNI or retail or PSU or SECI tenders for that matter. I mean, at the end of the day, as Inox Wind, we're supplying turbines. Having said that, I think the CNI market is just getting larger and larger. So maybe a year ago, our PSU market or order book was almost 70% PSUs. Today it's down about 35%. We've strategically also diversified across multiple customers. We have 7, 8 very large customers. We intend to add about 3 or 4 very large customers in the near future. And I think I would tend to believe C&I should be about 60 to 70% of the market as we move forward.
Okay, all right. Commercial and industrial, 60 to 70% of the market opportunity out there. But as you say, of course, you go where the opportunity is. Thank you very much, Devant, for joining us. It's a pleasure. And good luck to you and your team as you continue to execute well. We'll take a quick commercial break here. I think the market's down, back down again, actually. So we're down about 140 points, which basically means we're at the day's low. And there is a lot happening. Market breadth is again widened. I mean, the gap between what's up and what's down, the number of stocks up and down, that's again widened. And there are these single stock accidents. We mentioned Sun TV earlier, but Bharat Dynamics is another one, sharp cut. I just want to add 2 or 3 more. Balakrishna Industries is down 7%. It's actually come off the lows of the day. Low was 27.50. It's at about 28.50. But it's still down 7 right now. That's Balakrishna Industries. And then look at something like a LIC, which has also come off sharply. It's down 5%, reported numbers Thursday evening. And you heard from the management later on Friday morning. But stocks at about 1,080, down sharply. Astral, I mentioned earlier, that's another one. Fintech had a sharp up move last 2 days. That is down 5,020 right now. And Honasa, of course, which again reacting to earnings, is down about 5%. Stocks at about 451. We'll take a quick commercial break here. We'll talk more about some of these names, the market, and of course, we'll get back to that story in terms of the Hindenburg report. We'll have some experts join in to weigh in. We have Jayan Gupta, former ED, SEBI, and Sanjay Asher, senior partner at Crawford, Bailey and Company, joining in with their perspective on this matter. Stay tuned. Okay, welcome back. Let's shift focus back on the sort of news story of the weekend which came out. Hindenburg Research putting out allegations against SEBI chairperson on counts of conflict of interest and with regards to Adani Group and question of credibility, investigating the allegations against the Adani Group. Let's get in Jayan Gupta, former ED SEBI, who is joining in right now, and we'll have more experts coming on in just a bit. We have Sanjay Asher also with us on the phone line at Crawford, Bailey and Company. Sanjay and Mr. Gupta, great to have both of you here. Thank you for your time. Mr. Gupta, in a way, kind of unprecedented kind of news. This is a slightly unprecedented news story. The allegations being made against the SEBI chairperson, but responded to very fast and in a very detailed way. Your first thoughts on this entire saga, sir?
See, I am not surprised that there are allegations, because nowadays it is the norm that when you don't like somebody, when you have something, you start maligning the character of the person. So that is the norm nowadays. So don't be surprised, it is there. Coming back to the allegations and the rebuttal by Book family, I think it's fair, and I have no doubt that there is nothing, not even iota of truth.
Okay, I think the line froze, but he was just was opening comments. Sanjay, if you were with us, if you can hear me, good morning. Thanks for joining in. You heard a portion of course, what Mr. Gupta said, and we'll go back to him. But your first thoughts on this entire matter?
I agree with Mr. Gupta completely. It is absolutely character assassination and maligning the chairperson and her husband. They have amply clarified their entire professional career history, where they were, what were they doing, which territory were they, which jurisdiction they were, etc., etc. I don't want to get into the details, but to my mind, the clarification is self-explanatory. All the allegations they have denied, and I would completely believe them, keeping in mind their professional career, their stature, the fact that the chairperson has brought out so many reforms in SEBI, and she's absolutely passionate about getting into the capital markets and reforming it, which is why she left her private job and got into the job of a SEBI chairperson. So I have no doubt about it. And I'm completely with them in as much as that, yes, in all rightfulness, they've clarified everything. So there's nothing left in it. So it is some vested interest people, maybe in the market, inside India, outside India, some competition of Adani Group or somebody who has X to grind with Adani Group perhaps could have done that. But otherwise, I don't foresee any merit in what Hindenburg reports.
Of course, I mean, what is in a way, I think, according to me, a bit unfortunate is that it's also taken political color here in India. But Mr. Gupta, we lost you there. Please finish that point, sir.
So what I'm saying is very simple. When you look at the allegation point by point, it is something that I want to create a fiction out of nothing. And this thing is absolutely laughable, that in 2015 some investment was made when they were resident of Singapore, and in 2024 you are making an allegation that there was a co-investor Adani into that. Now I am asking you a simple question. Do you know what is going to happen tomorrow? You don't have no answer. So in 2015 you will never know that, oh, I will become chairperson of SEBI in 2023 or 2022. There will be a Hindenburg report in 2023. Oh, I will be investigating that also. Oh, it will be against Adani. Now, understand very simple thing. I ask a very simple question. When you invest money in mutual fund, do you go and ask the mutual fund, give me the details of all the 1 lakh or 2 lakh unit holders, let me do KYC of them. Oh, is there Adani as a co-investor in mutual fund, so I will not invest. And I wonder that why everybody is saying that I have not invested in Adani. What is wrong with Adani? Is Adani some black sheep or something that untouchable? There has nothing been proved against them. Everything has been generated. So I don't know what is the untouchability about Adani also. So the issue is very clearly, you pick up somebody, you create somebody as a monster, and then keep on building stories around that.
Right. No, absolutely. Mr. Gupta, from a... So what is... You know, Hindenburg put out another sort of list of questions, etc. I think this was early morning, late last night. I'm sure you would have seen it.
No, I haven't seen anything.
Okay. So how should the... I mean, it's kind of more of the same, but how should the... What should the response be now? I mean, does anything more needs to be done, or the clarification is out? And that's about it. What should the way forward be, Mr. Gupta? Okay, I think we lost the line there again. Sanjay, you want to take it?
Yeah, I would say if everything has been clarified by chairperson and her husband, then it is fine. Then they only have to give a simple denial. But if at all anything further allegations have been made on their investments or on their financial position, then they have to just clarify that, and they say, okay, look, we repeat what we have stated earlier, and we deny all the allegations for reasons of not traverse. But otherwise, you keep answering Hindenburg where there is no meat in there or there is no truth in the allegation does not help, because the match will go on continuously then. There has to be some full stop or some punctuation mark at some point in time.
At what point does that full stop come? I mean, we're just trying to figure out if there is any legal recourse, etc. as well, Sanjay. Just
legal recourse.
Yeah.
Legal recourse. If there is no truth, if there is no bit in the allegation, I would say they should file a defamation suit against Hindenburg. And there has to be some reform in terms of the likes of Hindenburg providing any report. And there has to be, government has to take action against Hindenburg, that any allegation they put, they try to destabilize the stock exchange, and stock exchange is the barometer of economy of any country. It's not only relating to SEBI or SEBI's chief. It is relating to the entire economy. There has to be some very strict disciplinary and stringent action, and they can't just keep reporting, issuing reports without factually finding out as to whether the facts which they are stating in the report are correct or incorrect. It can't be that they keep issuing report and we keep accepting it lying down. There has to be some action from our side in order to stop Hindenburg from issuing such reports and issuing further reports and further reports. It can't go on like this. So my point is that it is Mr. and Mrs. Bush should consider filing a defamation suit against Hindenburg, and two, there has to be some action from our side.
But where, which jurisdiction?
I mean, we can consider jurisdiction whether in India, because it is affecting not only India but elsewhere as well. So they have to this thing. Of course, the US law one will have to look at as to what the law is. But surely in India, because the report has been published in India and it is relating to her in India, so surely they can initiate defamation suit against in India.
Okay, all right. We'll leave it there for now. Thank you very much, Sanjay. Appreciate you joining in with that perspective. Mr. Gupta, if you can hear me, patchy line today, but appreciate you joining in as well. Thanks very much. Well, 120 points lower on the Nifty is what you have. 24,240. We are back, and we'll focus back on the market with some technical trades. Mitesh is going to be with us. Stay tuned.
Welcome back. 125 points lower on the Nifty. The mid-cap index has begun to sell off once again, down by about 0.75%. The first hour of trade trades at 10. Mitesh joins in for what he's made of the market so far and the stocks. Mitesh.
So, Mangalam, I think, it reaffirms that 24,400 is not getting captured in the short term, today's gap down, and the fact that the markets didn't try to go up and fill the gap. I think we'll take that idea of, maintaining some put options positions on the index and very likely suggesting a test of 24,000. And in case we start breaking below that, then another 200 to 50 point kind of a decline could happen. So the structure isn't turning positive with today's gap down being sustained. And on the stock side, I have one buy and one sell. Tata Power, I think, is breaking below swing lows. So keep a stop at 418. Look for a target of roughly around 396 over here. And the one which I like. I think, that's granules, which has been running and which has been making new highs and still strong. So that is a buy with a stop at about 656 for targets of 685.
Okay, all right, Mitesh, thank you very much for that. So those are some trades coming through. PSU stocks, as we highlighted, names like Bharat Dynamics and Mishra Dhatu are seeing very sharp sell-off, 6 to 10%. Hormuz is here with what's going on. Hormuz, over to you.
It's been a trend over the last few sessions where PSUs have reported results that have mostly disappointed the street. It started off with railway stocks last week with RVNL and Ircon missing results, and we saw the impact on these stocks as well. And Bharat Dynamics today, the revenues for the quarter were down almost 36%. The profit almost eroded completely, was helped by some higher interest income. The EBITDA loss was also higher compared to the same quarter last year. So it was not a good quarter for Bharat Dynamics. Execution issues continue to hamper the operational performance of the company, and that is showing up in the stock price as well. Was down almost 15% at one point of time, has recovered slightly from the lows of the day, but still trading with losses of anywhere between 10 to 12%. Midhani is no different. Even here, the revenues were down 13%. The profit was down 70% from last year. The margins also saw contraction from 22% to sub 14% for the current quarter. So not good results for Midhani as well. That stock too is down 7 to 8%. And a trend among most of these stocks is, despite all of these stocks correcting anywhere between 20, 25, 30% from their recent record highs, they are still extremely expensive on the valuation front. Both Bharat Dynamics is down 30% after today's fall from the record high. Midhani is down 22%. But on a one-year forward basis, Bharat Dynamics still trades at 36 times compared to the 5-year average of 30. And Midhani also is trading at a one-year forward of 35 times compared to the 5-year average of around 32 times. And this is after a 20, 25, 30% correction from the record highs. So not good going for most of these PSU names, and Bharat Dynamics and Midhani are leading that fall today.
All right, thanks very much for that. So those are two names in focus, and we'll continue to do the same for other PSU names as well. But commodities are back in focus. Manisha is here with what's top of mind. Manisha, good morning.
Thank you for that, Prashant. I'm looking at the crude oil prices, where we did see the prices decline quite sharply in the last month, but that has seen a rebound. So we are off the 8-month lows, and the prices did gain 3.5% in the previous week. So after 5 weeks of decline, we've seen actually prices gain up quite strongly onto that one. It has to do with the positive economic data that we've seen come in from Europe and US. It also has to do with the more and more bets now and higher probabilities of the first rate cut coming in from the US Fed in the month of September. Apart from that, there are supply concerns from Libya's Sharara field, and there is force majeure declared there. And then there are reports suggesting that you could be looking at Iran retaliation on Israel in coming few days. Markets also are looking at the US crude inventories, which have continued to decline quite sharply, now at a 6-month lows there. So when you look at the crude oil prices for the month of July, we did see that huge range of almost $10 between 87 to 78 on the lower side. For the month of August, we picked up from 78. We did see prices go all the way to $80 in the first week of August, but currently we are holding around those 76 kind of levels there. When you look at the Indian crude demand, well, there are all reports suggesting that India will see the max or the highest energy growth marginally coming in going forward. So from 2014 at 3.23 million barrels per day of a consumption, we stand currently at 5.4 with an expectation that we could be at 6.7 by the time it's 2030. If you look at the past 1 week then, and we've seen prices gain up quite strongly there, it's not just about the crude oil prices, but coal prices are trading at a 13-week highs. We've seen 8.5% of growth in the last 1 month itself. Also, when you look at the last 1 week, the gains have been quite strong. Coal, for example, is gained up by 2%. Crude is up 5%. Strong 14% of gains is what natural gas put out. And we've seen 9% of gains coming for the gas prices in the matter of last 1 week itself. This week is going to be important because of two reasons. One, you have the Indian inflation numbers coming in today. And then you also have US inflation, US retail sales data also expected in this week. And the markets would react to that.
All right, Manisha, thank you very much for that. Well, we'll take a quick commercial break here. We are going to come back. Lata will connect with Suresh Ganpati, banking analyst at Macquarie, to focus on the first quarter earnings for the banking sector. Stay tuned.
Welcome back. Even as the banking result season ended with SBI, we got the global equities rout, which pushed up expectations of Fed rate hikes. And this was followed by a surprisingly hawkish monetary policy from the Reserve Bank. So at the end of it all, how are banks placed in terms of future margins, loan growth, deposit growth? For all these questions, I have with me Suresh Ganapathy, the banking expert from Macquarie Securities. Suresh, welcome. Thank you very much for your time. Let me first start with what the SBI chairman Dinesh Khara told me on Monetary Policy Day about a simultaneous fall in bond yields exactly when deposit rates are shooting up. Just listen to him. I'm coming back to you.
There's a change in the interest rate structure when it comes to the lending. A lot of loans are being priced linked to the T-bill. And today, the way T-bill is behaving, in fact, the market is actually from that perspective, as far as T-bill is concerned, it's coming down. But when it comes to the liquidity issues, that actually forces banks to go for the higher cost of deposits. In such a situation, perhaps when RBI has said that they are concerned about the interest rate movement in deposit rates, I think it's quite justifiable. But I would say that there are various sub-segments in the market, and they're all getting priced differently.
Okay, Suresh, the long and the short of it is the banks are facing pressure on both sides. Irrespective of what the results were, is life getting tougher? Should we be prepared for lower margins?
Yeah, I mean, that's very clear, right? So he's saying that there is pressure on deposit rates, and you have seen obviously all these banks coming up with some special deposit schemes. And funding still remains a challenge. And even the Reserve Bank of India governor said that you have to come up with some innovative schemes to get deposit growth. So clearly, there is on one hand pressure on the funding costs, and on the other hand, obviously, you have loans which are priced off T-bills, priced off external benchmark rates and stuff. So that is also showing pressure. The latest data from the Reserve Bank of India very clearly shows, specifically when it comes to the public sector banks, the weighted average deposit rates have gone up, but the weighted average lending rates have remained flat of late. So that clearly shows that there is more margin pressures to come for the sector in the coming quarters.
Okay. So will you tone down your margin expectations even after the reports you wrote after the results? Especially now, let's start with SBI because the results came the last.
Yeah.
Are you going to bring down the margin expectations and even loan growth expectations? Because after all, the raw material has become expensive. Money.
Yeah. Look, I think, I mean, about 6 months ago itself, people obviously knew that there is pressure from the funding side, and therefore that will spill over to the lending side with respect to the ability of the banks to grow their balance sheets. So loan growth estimates have already been pared down. What I think most of the analysts, or for that matter, the market has got it wrong in our view, is the fact that we thought we have almost reached the bottom level of margins as of 4Q, but 1Q very clearly showed that margins continue to remain under pressure, and nobody expected, Lata, the LCR guidelines to come and take shape in the current format. Obviously, we know it's a draft guideline, but clearly the Reserve Bank of India is wanting to implement with effect from 1st April 2025. So before that, clearly banks will have to beef up their liquidity coverage ratios or realign, right? So either it means focus more on retail deposits or invest more in government securities, and that is the additional downside pressure to margins. So yes, across the board, for both PSUs and private sector, we do believe there will be more margin cuts coming forward in our view.
Okay. Your view on SBI itself?
We do have a self-recommendation on SBI. I think, Lata, what we are arguing here is that the ROAs have clearly peaked. There is downside pressure to the ROA coming from lower margins. And also, obviously, we will discuss this a bit later on the ECL norms perspective, whereby there will be some upward bias in terms of provisions. And we've also seen off late in the results, which we will discuss later, some signs of stress emerging across the board, right? So, so clearly credit cost normalization is only going to gather a little bit more amount of steam in the coming quarters.
Okay. Before I come to this, credit cost and the fact that unsecured loans have shown stress,
Yes.
You wrote a note to that effect. Before that, let me first finish off HDFC Bank. They also stunned the market with a fairly high-yielding deposit announcement. I think 1 to 3 years, they give you now 7.35, which,
Correct.
If HDFC Bank gives you that kind of money, others will have to, at least match. So what is the expectation from HDFC Bank itself? Are you toning down their margins? What's the opinion on that bank?
Yeah. So look, I think they are in a peculiar state in a way, or what has happened actually. Of course, if you look at it, Lata, if you look at the ALM pattern, they do have large amount of borrowings maturing by the end of this year. And if I were to really compare the borrowings, the 1 to 3 year bucket, and the deposits in the 1 to 3 year bucket, I think if they are able to garner deposits even at a slightly higher rate at about 7.4%, as we talked about, and the borrowings are coming in at 8%, or rather there are existing borrowings at 8%, it makes every sense to take those kind of deposits and replace the borrowings. And what exactly happens is they have an idiosyncratic issue which results in them actually having an ability to bring down their cost of funds, because their cost of funds is affected because of the merger. That's not the case with others. So in that process, everybody else gets affected a little bit more negatively compared to HDFC Bank. And therefore, if you look at this quarter itself, well, everybody else faced margin pressures. Their margin did go up by 3 basis points. I know it's a small number, but at least directionally it was good, right? So that really goes to show, Lata, that they are in a different situation, and therefore I think they should be in a position to maintain, or in fact improve margins from current levels, and report that 14-15% earnings growth that we are talking about.
Okay, now let me come to that unsecured loans note that you wrote. Who are the biggest casualties and who are the winners?
Yeah, look, I think, Lata, let's understand that there is no casualty as such, because we have to understand that these portfolios are very granular. The risk is also concentrated in specific segments in the unsecured space. It's not across the board, all ticket sizes. Certain pockets, certain geographies, and of course, certain stress on the credit cards portfolio. So what exactly happens here is that while there is going to be an uptick in the credit cost, it's going to be well within the manageable levels. The only problem here is what is getting priced in, right? So the first instance of some normalization levels of credit cost results in the markets getting a bit more jittery. I would still presume, even for that matter, PSUs we have seen, which has seen an increase in the personal loan delinquencies. Remember, for SBI, it is a very small, low-digit percentage of the overall portfolio. Same is the case with Bank of Baroda. So it doesn't move the needle in a very big way. But yes, the fact that you are running at 30-40 basis points of credit cost, even if you end up having 10-15 basis points additional credit cost, to that extent, it is negative on the ROA, earnings expectations, and of course, eventually ROE.
Okay. Well, banking stocks or the banking sector has been the underperformer of the market. So the market probably got it right. They could see that banks are going to be in for margin pressure, for probably asset quality pressure, even if it is marginal, and of course, technology investment pressure. Given this, what would your ranking be of banks? Who will be able to stem the tide?
So to a great extent, if you look at the numbers here itself, the private sector banks are still generating, despite this kind of an outlook, anywhere between 15 to 16, 17% kind of an ROE. Let's take that range, right? So, and the valuations are still very comfortable at this point in time. So even if you assume there is no further aspect of re-rating from current levels, 15 to 17% ROE can itself result in that much amount of power of compounding over the course of next I would say 2-3 years. So I would still stick with private sector banks. Also, the argument narrative is coming from the fact that Lata, they are gaining market share on deposits. If you look at the deposit growth of both SBI and Bank of Baroda, it's been pretty weak in single digits. So clearly they're losing market share on that. There is a greater impact coming from ECL norms for the PSUs compared to the privates. The privates carry contingent buffers and provisions. So those are some of the advantages that the private sector bank has over PSU. So you're still sticking with the larger private sector banks at this point in time.
Okay. Let me quickly get the fintechs in and then come back to the banks if I have time. There are two fintechs you cover, 197 or Paytm and PB Fintech. Where are they in this whole picture? Are they better able to stem the tide of margins? Are they showing better business growth?
So definitely PB Fintech has been doing a better job in our view. Growth has been, of course, surprising us positively. continuously. In fact, over the course of last several quarters, they are gaining a greater market share in the segments that they're operating. One area where there has been a clear progress that has been seen is on the health insurance front, where very clearly growth levels continue to remain very strong. And they have a very small market share in the savings product segment. So coming off from a low base, they're doing pretty well. And interestingly, they've also been in a position to manage expenses and show operating leverage in their business. So in that sense, PB Fintech is, in our view, in a much better position. I still believe when it comes to 197, there are still a lot of pulls and pressures. When it comes to the loan dispersal that they do, I still believe there's quite some time away before we actually start seeing reasonable amount of growth in that segment. And secondly, I'm still not very convinced on the regulatory and aspect, right? I mean, time and again, they have, of course, had these run-ins with the regulator, and therefore we need to get a little bit more amount of comfort before we actually begin to get constructive on that name.
Time completely, Suresh. One word on your best pick.
Oh, in the current environment, I'll still stick with the two largest private sector banks, which is HDFC Bank and ICICI Bank.
Okay. All right. Unfortunately, out of time. Thank you very much, Suresh, for rounding up both the macro pressures of Fed and RBI, as well as the regulatory rules and the earnings in a very short chat. That's the word from the banking analyst. We have to take a break and come back with Chartbusters.
Sun TV, the stock under pressure, down almost 9% as the company reported an operational miss in the first quarter. The revenue fell 5%, while subscription revenue too dipped about 2% despite price hikes on account of NTO 3.0.
Voltas climbs more than 7% after delivering a strong showing in the Q1 numbers that were above estimates. The revenues from operations are 47% on a year-on-year basis. Strong growth from the UCPS segment and sharp recovery in the EMPS segment.
Muted management commentary takes Balkrishna Industries lower despite posting an in-line set of numbers. They expect minor sales volume growth in FY25 and see tepid demand environment due to macro challenges. That too takes the stock down by about 6%.
Jubilant Foods surges as the company delivers a solid set of numbers in the first quarter. The revenues increased by 10% on a year-on-year basis.